a market crashes? How and if when a market crashes, what do you need to do to prepare for it so you maintain the value and the cash flow of your property and your property portfolio so that you don't have to fire sale it and end up with nothing? Here's my top 3 tips to help you avoid and help you keep and hold on to the value of your real estate even when the market crashes. This means that with these 3 tips, you can actually, when implemented, avoid suffering a market crash in your portfolio. Even though the rest of the market is crashing, you are safeguarded from it. Now, my name is Helen Tarrant. I help everyday Australians become wealthy through commercial property investment, helping them to build cash flow, growth, and uplift. If this video is relevant to you, please book into a free strategy session where we can implement everything that I'm teaching you on the commercial basis for your individual journey and help you get to financial freedom faster. My top 3 tips on how to safeguard your portfolio if the market crashes is number 1 is value. Value is really important. This happens when you buy. A lot of people buy looking at the trends. If someone's buying industrial, someone's buying in Perth, someone is buying a duplex site, they go in there and they buy it because that's what they read in the papers, that's what their friends are doing, that's what their advisors like accountants and solicitors and advisors are doing. They never think about counterintuitive investing or the inherent value of that property, right? Because ultimately it is the value that carries in the property that safeguards you no matter what's happening in the market. Now, a prime example of this is we still see auctions of properties during market crashes where the property has gone above reserve by so many hundreds of thousands of dollars, and you're wondering, how the hell did that happen? We're in a market crash, people have no money, high interest rates. How did that happen? It's because of inherent value. We see those in big auction houses where we see McDonald's, KFCs, we see Bunnings being sold during COVID. Bunnings was still being sold at a record high prices with record low returns. Chemist warehouses were sold at high prices even though they have very little returns in terms of cash flow. But it's the stability and the inherent value of the property with the tenant in it that held its value even during market crashes. There's properties where they're on a certain amount of land with the houses with ability over maybe 2 lots and the ability to be rezoned in the future for medium density or dual occupancy in the residential space that held their value even during the pandemic, during the GFC, and any market crashes to come in the future. So I want to talk to you about value. What exactly is value? Value is how the market sees the property, not how you see the property, but how the market sees the property. What does that mean? That means that if you want to be thinking about your future customer when you buy this property. So what is my future customer want? My future customer want this property to have potential. My future customer want this property to be solid. So is it in a good location? Does it attract the right type of tenants? In the commercial space, does it attract the right tenant? Is it surrounded by the right tenant hub? So for example, you're buying in a business park, regardless of you buying the office space, the retail space, or the warehouse space in the business park, you got to ask yourself this question. Now, is the tenants that surround me able to draw like-minded tenants for the future of the property? So are they surrounded by trade, professional, and tenants that can afford the rent as it goes up? If it does, then you tick the box for that it will maintain its value in terms of rent and the value of the property, because constantly there's going to be the same like kind of tenants coming in. The same goes with an area where you have very centralized but very high level professionals. Now, we've all seen areas where, say, the councillors are together on one street. So you've got the British councillor, you've got the Chinese councillor, you've got the New Zealand councillor, you've got the Greek councillor, you've got all of them in one street. Well, if one property on that street becomes vacant, another councillor is going to come in. Very, very logical, right? Just like a medical hub, when you've got your doctors, your specialists, your psychologists. If one space becomes vacant, you're going to get another specialist come in. Very, very self-explanatory. This is value, right? Value, inherent value built around other tenants, other like-minded people, just like communities out there, right? So if you look at houses along the street in certain suburbs, they're all 3 or 5 million. If one gets sold, it's bound to be at that price no matter what the market is doing. So this is what I'm talking about, value. When you look at a property, when you start out, instead of following the trends of the market, look at the inherent value. In the future, is the value still there? Is the other like-minded tenants, similar tenants, high quality tenants going to stay in this area, come into this this area? That is the question you got to ask yourself when you purchase. It's about value. Number 2 is about versatility. Versatility. Now, you might think, well, I bought a house which is a 4-bedroom by 2-bathroom with 2-car garage. What's the versatility, right? Now, versatility actually applies to commercial property more than it does for residential. When you have 4 bedrooms and 2 bathrooms, the versatility is, can you put a granny flat at the back? Can you do an extension? Can you go a second floor? Can you go dual occupancy? Those are the things that are going to be the versatility, but that means that you're going to have to put in a lot more money, right? Compared to the commercial property space. Now, in the commercial property space, that's not about putting additional money to create the versatility. It is actually about the premise itself, right? For example, a retail premise is a lot more versatile than a warehouse premise. A warehouse premise cannot host a dentist, cannot host a psychologist, right? Cannot host most of the time a law firm, right? Whereas you have a retail premise, it can host a law firm, an accountant, a hairdresser, a cafe, a dentist, a government tenant, all sorts of tenants, a training organization. All of these things can be versatile and they can go into the same premise. So it makes it easier for you to find the next tenant. It makes it that much more easier for you to have less vacancies, for you to adjust rent and to go along the market ups and downs. So let's say that this area gentrifies and this area changes and becomes fancier. You first started having your mum and dad cafes, your little op shops, maybe your dollar stores along the street, and all of a sudden there is a new hospital being built 5Ks away. All of a sudden, you've got more house and land packaging built. Now, your commercial property is going to have more foot traffic, but it's going to be more professional tenants. Now, within 5Ks of a hospital, you're going to find there's going to be psychologists that want to operate there. You're going to find NDIS government tenants that want to be there. You're going to find dentists that want to be there. And you probably will find really upmarket tenants who want to occupy that space. All of a sudden, instead of charging maybe $400 a square meter, you're now charging $500 or $600 a square meter because you're in a niche space. But the most important thing is it's versatile. You can do multiple things with that property, and that maintains, again, coming back to the value, but maintains the rent, and it also maintains that the fact your property is going to be continuously tenanted no matter what the market is doing. Even if the market is crashing, you will have still that demand. Remember, during the COVID period, the people that are most in demand are your health professionals, your chemists, and also destination tenants where people need to go there, get something and leave. That's what I mean by the versatility of a property. Now, if you're enjoying this video and you're thinking these 2 tips are really helpful and I really want to learn more about how to invest in commercial property, how I can actually achieve financial freedom in half the time I would in commercial than compared to residential, then you need to join our community. We have the largest community here at Unikorn Commercial Property, largest community of commercial property investors. So click the link below, join our community for a minimal monthly amount, and you get all the benefits of meetups, our webinars, continuous education, but understanding how to get started in the commercial property space. Now, let's move on to number 3. Now, number 3 is a key in this market, and that takes a little bit of study. So it's not something that you just read in a magazine. It takes some research. That's demand and supply. Demand and supply is very different in residential versus commercial. In the residential space, demand and supply is really, look, along the street, how many houses are for sale? Is June versus September a better time to sell? And when are people buying? And if there's less things for sale in an area, prices are going to go up. Now, in commercial, we're looking at 2 levels of demand and supply. We're looking at demand for that type of property. So for the moment, there's a lot of demand for industrial properties. A lot of tenants are looking for industrial properties because they think, well, I can do business to business here, business to consumer here, and I can also operate a part of my business here online, right? So they're doing all of those 3 things. So they're looking for an industrial warehouse property. Now, that's really great when you're looking at it from a customer point of view, thinking, I'm always going to get a tenant. But you need to also look at demand and supply in terms of how much development is coming into the market, what exactly is in demand in terms of what the tenant wants. Now, a lot of people are buying 140, 150 square meter warehouses. Yes, they're really great now, but in 2 to 3 years' time, will they hold that value? Now, going back to my point number 1, will they hold their value? Are they versatile? Can they be anything else but the host, the current tenant that's in there, right? Because when you look at it, it's basically, when you 100 square meters, you're finding that maybe in this area, maybe not, there might be lots of land and developers are developing new industrial warehouses that's going to come online in the next 2 to 3 years, which means that you might have a dip in your rent, you might have a dip in the value of your property, and it's not going to safeguard you during a market crash. But what will safeguard you in a market crash, perhaps a 250 square meter warehouse, a 300 square meter warehouse. Those warehouses may be divided into two, back to versatility. They may hold its value because it's surrounded by other like tenants that are stable and stay there for a long time, not transit tenants who start out with 140, but really looking for 300 square meters in space. Now, ultimately, you have to research the market in a particular area on demand and supply. Now, what we're looking at is what is the lowest in terms of vacancy, but also the rising rents. Is the rents on the rise for that particular type of property? And also, are you going to have overdevelopment and oversupply in the next few years? Now, when you are safeguarding a property and looking for demand and supply, you're not just looking at what's going to happen in the next 12 months, you look at what's going to happen in the next 24, 36 months, because remember, investing in property, especially commercial property, is a long-term game. We're going to look ahead 5, 7, and 10 years, because what we ultimately want to gain is through those 5, 7, 10 years, the stability, but the ability to add onto our portfolio so that you can get to your financial freedom figure. Now, if you are looking to have someone help you get to your financial freedom figure, which might be $50,000 in passive income, 150 or 500,000 in passive income, reach out to us, Unikorn Commercial Property, HelenTarrant.com, where I'm going to be able to help you work out a strategic pathway, a blueprint where you get crystal clear vision how you can get from A, where you are now, to B, where you might want it, where your passive income is, and how long that's going to take, the type of property you're going to need, and the kind of investment you're going to be needing to put in, so your kind of deposits. Now, booking for that free strategy session, obligation-free free strategy session, where we can personalize all of this to you. Now, in the meantime, keep building that portfolio, keep searching, and I'll see you in the next video.